Mentioned the speed in which rates have gone up. Was it faster than you thought? And it also, does the fact that it went up in the manner at which it did lead you to believe we're closer to the end of this recent move or merely getting started?
I think it's more like in the middle of the move. What I expected is that when we got to 325 on the 30-year, if we broke above it, it would probably break above it with authority. And it sure did. I mean, that one day that it broke above 325, I think the long bond dropped over 2%, 2 points that day, and there was a rout across the entire yield curve. And that was followed by weakness the next day, and then another acceleration, which I expected, up to around 344 or so on the 30-year Treasury. That makes sense to pause there. But if you look at the charts and you look at the way the market's behaving, and you think about the trends that are underneath the bond market, it wouldn't be surprising at all to see the 30-year go to 4% before this move of the breakout above 325 is over. And the curve should probably steepen. So maybe the 10-year Treasury makes it to 350 or 360 during that move. One of the things that is really fascinating about this sell-off in bonds is it's happening in the context of a really high short position against the Treasury market. It was actually by far the highest ever on the data series, not by a small amount, by a very large amount. And with this sell-off, you'd have thought that maybe it would be braked a little bit by all of that short positioning, maybe looking to take profits, because rarely do you have this kind of crowded positioning in a market, and they're all making money on it. So that was really interesting. I think one of the reasons that people are comfortable staying short the bond market, number one, obviously the Fed wants to tighten. And, you know, ultimately, if the short rates go higher, that creates competition because the spread isn't very big. But also, investors are starting to realize just how many bonds are coming at us in the year and two ahead. And I've talked about this repeatedly over the last couple of years. We had a budget deficit in the United States that went up from around $600 billion a couple of years ago to now the official number for fiscal 18 is a little over $900 billion. But that doesn't really capture how much debt is really being added to the national debt in the United States. Because if you just look at the deficit, there are certain things that aren't included in there. Importantly, there's a loan to the Social Security system that is a very big number, and it takes the increase in national debt for the fiscal 2018 is not $900 billion. It's $1.271 trillion. And that's a cash accounting way of tracking the growth in the debt. If you use accrual accounting, which companies have to do when they report their financial situation, they have to accrue things like pension liabilities. Well, we have pension liabilities in the United States, too, like the veterans benefits and so on that have been increased. And back a couple of years ago, we don't have data for 2018 fiscal yet, I don't think. But a couple of years, the 2 years before that, I think we had about $400 billion of accrual that is obviously going to have to be borrowed in the future at some point for these liabilities. So in essence, the actual growth in liabilities is more like $1.7 trillion in the United States. And on top of that, you have the Fed now cranking up quantitative easing to $50 billion a month, which is another $600 billion for fiscal 2019 if they continue on that course, which takes you to around $2.25 trillion of debt increase, Judge. And this is at a time where we're supposedly in a good economy. GDP, real, was over 4% in the second quarter. It might be in the high threes for the third quarter. And here we are, we're supposed to be having a surplus, and the deficit is expanding. Ladle on top of that, the debt to GDP ratios in many other developed countries, and ladle on top of that $10 trillion per a McKinsey study that came out about a month or two ago, that global corporate bond maturities are something like $10 trillion over the next 5 years. So there's a kind of a problem with the compounding curve on debt service, and I think that people are starting to realize that we're going to have to take down an awful lot of bonds, and we're getting more isolationist in the way we're dealing with things, and maybe we won't have our foreign creditors continue on with their willingness to accept our bonds at these levels
so let me ask you that.
Of yields. Maybe they have to go higher.